Hey guys, today I'm going to explain what call and put options are. Make sure you subscribe and turn post notifications on. In this video, we're going to go over buying calls and puts, also known as long calls and long puts, which is the basics of options trading. If you're interested in writing call or put options, I'll make a separate video on that. So without further ado, let's get started. A call and a put are very similar. They are essentially the same concept, but opposite. Let's start with the call. A call gives you the right, but not obligation, to buy shares of stock at a fixed price in the future. Now this might seem a little bit confusing, but I'll break it down for you. First, you have to understand that a call option is a contract, and within every contract, there are certain terms of agreement. The terms of a call are the numbers of contracts being purchased, the strike price, and the expiration date. Each contract represents 100 shares of stock. So if I buy one contract, I will be essentially buying the right to own 100 shares of stock at a fixed price, the strike price, in the future. Future being when the option expires. The second term is strike price. The strike price is the price you choose to buy shares at. For example, if the stock is trading at $100 and I choose to buy one call with a strike price of $105, which is out of the money, that means I will have the right to purchase 100 shares at $105 at the contract's expiration date, or even before for US options. The farther the strike is out of the money, which means above what the stock is trading for, the cheaper the contract will be. Now let's go back to the previous example where we had a strike of $105. The contract might be around $300 to purchase. If I were to buy farther out of the money contracts, let's say at $110 instead of $105, then the price to purchase that call will be cheaper because the likelihood of the stock reaching $110 is less than reaching $105. Now let's get on to expiration date, the last term. The expiration date is when the contract will be closed. If your contract is in the money, which means the stock price rose above your strike, it will most likely be exercised automatically, which means you will receive the shares at the strike price for a profit, but speak to your broker to double check. If it's out of the money, which means it has not gone past the strike price, then it will expire worthless and you will essentially lose all of your money that you paid for the option. You can also sell your option before the expiration date, which many people do. If your contract rises 40%, which within a few days, you can sell your contract to someone else and keep the profit. Conversely, if your call options lose 40% of their value, you can sell it to cut your losses. Another reason why expiration is so important is because every day that goes by, your option will decrease in value due to theta, also known as time decay. Theta is a measure of the rate of decline in the value of an option due to the passage of time. Theta is generally expressed as a negative number and can be thought of as the amount by which the option's value will decline every day. If you buy a contract that expires in a week, you will see a faster decline in the option's value due to theta than buying a contract for a month because there's more time left. Theta is part of what is known as the Greeks for option. The Greeks consist of theta, delta, gamma, vega, and rho. These essentially identify how the contract will rise or fall in value over time. The Greeks are a more complicated part of option trading, and I will explain that in another video. Now let's move on to the puts. Buying a put is a bearish perspective on the underlying stock. If you're buying a put, you want the stock to decrease in value in order for you to profit. Much like a call, the puts have a strike price, an expiration date, and a number of contracts that need to be taken into consideration before purchasing. The concept is the same, except you are buying the right to sell shares at a fixed price in the future. So let me give you an example. Stock XYZ is trading for $100 and your strike is out of the money at $95. The stock goes down to 90, which makes you a happy person. At the end of the contract, you have the right to sell, also known as short, the stock at $95 when it's trading for $90, which means you just made $5 per share, making your overall profit $500. You can also sell your contract before it expires. One thing traders need to do before the contract expires is see if they want to sell the contract for a profit or exercise it. You will most likely get more from selling it because it has extrinsic value. People who exercise the contracts usually do so because they want to hold onto the stock long term. So overall, it's just a choice of holding long term versus taking the most amount of money possible. And if a quick profit is what you're looking for, selling the contracts prior to expiration would be the advantageous decision. And that wraps it up. Thanks for watching, and I hope this helps. Make sure you like, comment, and subscribe. See you in my next video.